Hi, MSL here. Welcome to our strategic case study pre-scene analysis for Engineered Wood Limited. This is for anyone sitting the November 2025 ICAG strategic case study exam. Now, what will this cover? This will share my preliminary thoughts, my initial thoughts. Preliminary and initial because the pre-scene was released just yesterday, Monday, the 20th October. Today is 21st October, Tuesday, next day. And it's 6:26 a.m. according to my clock, right? So this will be my initial thoughts, my initial impressions, right, over the pre-scene. This is to guide anyone preparing for the exam to also do your own analysis and prepare better for the exam, right? In terms of what we'll be discussing in this session, we'll do an overview of the company, right? We'll look at a summary of the industry, and then we'll touch on some aspects we need to remember and know about the company very well. We'll look at governance in terms of corporate governance. Now, your examiner is going to allocate 20 marks to corporate governance. So you should be prepared to answer questions on the company's governance. Now, this session would point out some flaws, some weaknesses, and give you some ideas as you are also doing your analysis, right? To know what the corporate governance shortfalls are. We'll look at some financial information. Of course, this will be limited to what the pre-scene information has given us. We'll apply some selected strategy models to the pre-scene, and then I'll leave you with top 10 strategic questions to think about, to ponder about, to meditate on as you prepare for the exam. Now, before we start, this is for those writing the November exam. We usually run a 2-day deep dive session. Now, when I say a deep dive session, we take the pre-scene and we apply it to the entire syllabus. So as long as it is a model in the ICAG syllabus, we're going to apply the pre-scene to that model. We do it over a period of 2 days, Wednesday, the 29th of October this time, and Thursday, 30th October, 2025, right? The time is 8 a.m. to 3 p.m. on both days, right? So if you join, you would get a very much detailed understanding, full syllabus coverage for the strategy areas complete. We'll touch on governance as well into details, right? So that is it, applying the models in the syllabus, all of them, to the pre-scene. So you have a better appreciation. This should aid you in your own analysis as you are preparing for the exam. To register, visit our website. You could also send a WhatsApp to our number here and you would be assisted. So let's start. So the company, like I said, is called Engineered Wood Limited. Now, like I said, this is quite an interesting company. We haven't seen something like this in quite a while, right? So what are they into? What's their business, right? So in terms of a summary, they were founded in early 2015. So they're not too old. They're not too young either, right? They're quite in the middle somewhere. And key point is they are a privately held Ghanaian company. This is important because it shapes your understanding. They are not listed. They are not a public company. They are privately held. Now, to make it even more interesting, they are a family-managed business. So it's managed currently by the founders, Mr. and Mrs. Turkson. When we get to governance, I'll talk about some additional areas. You realize that it is predominantly family and friends, kind of, right? Managed. And that brings a whole new perspective when it comes to corporate governance. This is not your typical company with the best of governance structures, as we'll find out shortly, right? The company's core business revolves around what they call a one-stop shop model. We'll come to that in our discussion, right? What is their business model? Really, what are they into? As a candidate, what should you know about this company? Basically, EWL is into importing, distributing, and providing value-added services such as high-precision cutting and edging for what we call engineered wood, stones, quartz, and accessories, aiming to be a complete solution provider for its customers. So basically, they are into the building, construction industry, right? And real estate, they are embedded, right? Now, this is how engineered wood looks like, right? Special processing, and it's used for different purposes, for building, right, for construction, for interior decor, so many things. In terms of a key differentiator, we are told in the pre-scene They have invested in state-of-the-art, high Italy and Germany, and this allows them to offer a level of quality and finishing that their competitors cannot easily match. This is called a competitive advantage in strategy. It is something you can do that your competitors cannot easily do. Of course, they can also import these machines and also do what you are doing, but as it stands now, it is a key differentiator. It's what makes them stand out from competition, right? Nobody in this life is without challenges. What are some key challenges facing this company? The first is we look at the external challenges. They operate in a difficult market. They face intense competition from cheaper imports. That's the thing. You see, they focus on some types of imports, which we'll see shortly, right? So those who import cheaper are able to undercut. We call it a price war, okay? It's like a race to the bottom. So cheaper imports are competing with them. So they are not able to price as much as they would because there's pricing pressure, right? We also have significant macroeconomic headwinds. We'll see this in our PESTEL analysis, right? So we've got currency volatility. The CD is not stable. We've got brand dilution, which is caused by artisans misrepresenting cheaper products as EWLs. So we've got artisans, right, who do the construction, the interior of buildings, who are now passing off inferior products, cheaper products as that of EWL. So it is also eroding the brand perception. People know EWL to be for or to stand for quality, right? Now, this is a challenge because it is going to affect their positioning in the market. If people say, oh, I know this company for quality, and all of a sudden I start to see inferior products, I start to see cheaper products as yours, my idea of you changes as a company, right? So we need to look at these are some challenges. Then we come to internal challenges. EWL is constrained by critical internal issues. I think the biggest one should be their weak corporate governance issues. Why? They are dominated by a family. Like I said, it's a family-run business. So it makes it very difficult to do any serious governance. And I'll talk about the mindset of the people inside the company when it comes to governance. They don't think governance is anything important, right? So they are dominated by a family. We also have challenges regarding conflicting leadership styles between the founders. We've seen severe HR problems. When I say severe, I'm not exaggerating, right? There's serious HR issues with this company, most notably being the high staff turnover. People leave the company a lot, right? People quit. So there's a lot of turnover. Now, this is an important thing to think about because as a company, especially in this industry, you need to keep skilled labor, people who understand how to machine the wood, finish it, put it in the form you want, right? If people are leaving all the time, then you are losing skilled labor. And it's going to cost you more to train them and retain them, right? So this is a very big issue. In terms of their strategic direction, according to the pre-scene, where is the company heading? They are pursuing an ambitious growth strategy. They are very, very ambitious. For them, they are thinking of doing expansion. One domestic, one international. So they plan to expand to Kumasi by 2026. So this is within Ghana. And they are thinking of a high-risk international expansion to Nigeria, where they plan to do sometime early 2029. Of course, companies would want to grow and expand. But the question is EWL ready to go to Nigeria? Of course, things could change, right? But looking at the company's current stance, their current position, especially regarding governance, are you a company ready to enter a new market? Not just any market, a market bigger than the Ghanaian market you're currently, which is Nigeria, right? So we'll discuss and ponder, think about these things. Okay, so these are the key challenges facing the company. Let's do an industry and company overview next. So the global market for this is a mature, close to $200 billion market as at 2024, based on the pre-scene information. It is driven by the global construction industry and the demand, right? We've also seen a strong sustainability trend. Currently, we are saying that Asia Pacific, led by China, their massive production capacity is what is a dominant global player. So more than half, that is approximately 60% of global panels, come from the Asia Pacific region. Of course, this will talk or lead to what we discuss when it comes to the suppliers, right? We talk about the bargaining power of suppliers. Okay, which we look at under Porter's five forces, right? So you know where your suppliers are, and this makes a lot of difference because you don't have too much control over where you source your materials. In fact, as we'll find out shortly, this company is predominantly focused on imports, right? So that's a global market. How about Africa? How is it looking here? In Africa, we are saying it's a nascent market, it's a growing market, right? Between $2 to $3 billion as at 2025 numbers. The potential we expect to be unlocked by the Africa Continental Free Trade Area, which is expected to open the borders, open the borders for different countries so that people can exchange goods and services, of course, with subsidized import duties, import taxes, right, to make the free movement of goods and services a reality, right? So we expect the Africa Continental Free Trade Area to grow this market further. However, its growth is currently constrained by infrastructure gaps, political instability, and a high reliance on finished product import. So even though the African market is growing, we are still predominantly relying on imports. So we still expect to fill the gap, right? Infrastructure gaps because we do not have the kind of skill that the Asia Pacific region has, the kind of machinery, skilled labor, talent that China has, for example, we do not have in Africa fully, right? So there's a gap to be closed. Of course, political instability in selected African countries. Then how is the Ghanaian market looking? Generally, it's divided into two distinct segments, right? Local manufacturing, where they lack the technology for advanced products, and then importers or distributors. This is where EWL actually operates significantly, right? Where here we supply advanced products that the local markets cannot produce. So in the Ghanaian market, see it as a two-pronged approach. There are two parts of the market generally when it comes to this industry, right? There are those that manufacture locally and those that import to supply locally. EWL imports. The imports are supposed to fill the gap that the local manufacturers cannot cover, cannot close, right? Of course, because of quality and, like I said, the infrastructure, the power, the talent, the experience that China will have, we don't have in Africa, right? Let's delve deeper into Ghana's wood industry segments. Like I said, we've got the local manufacturing. They lack the technology for advanced products like what we call the MDF, medium density fiber board, and oriented strand board, that is the OSB, right? So it's severely threatened by illegal logging, which is galamsey, and deforestation, which has depleted the supply of quality local timber. So in addition to the fact that we may not have the skills locally, there are other challenges. Galamsey, we are cutting down so many trees in Ghana, illegal mining, illegal logging, right? And because of that, even the supply of quality timber to process into these finished wood products is declining, right? So not only is it going to be a skill issue, it's a local supply issue, raw material supply, right? So local manufacturing is suffering. For importers or distributors like EWL, I'm saying for them, they supply the advanced products that the local market cannot produce. One thing to remember is that this is a very highly capital intensive segment. It requires an estimated $10 million, right, for adequate stocking. So this is a very capital intensive segment. What does that mean? When we get to Porter's five forces, right? Can anybody enter the industry? How easy is it for new entrants to enter? They would have a barrier of entry, which is what? The minimum capital requirement or initial capital, right? In terms of EWL, we've been told that for their market position, they're a significant and respected player in the industry, and they have been described in the pre-scene as a force to contend with. In terms of their business model, they said they want to have a one-stop shop solution, but it will be backed by a high fixed cost base due to expensive machinery. They also have high operational gearing, and this means that profitability will be very sensitive to changes in sales volume, right? There's a relationship between operational gearing and your sales volume. So it's something that will affect them because they have a very high fixed cost base. Now, for their strategy evolution, they were originally a premium only brand, according to the pre-scene, but intense price competition forced them to now adopt a hybrid strategy. So thinking about what we call Porter's generic strategies. Generally, you could do cost leadership, be the cheapest in the market. You could do differentiation, offer something unique, something special so you can charge higher. You could do hybrid, right? Or what we call the focus model. So here, they are doing a mixture of the two. So they introduced relatively more affordable boards to compete for the price-sensitive artisans and developers, successfully reversing the negative sales trend. So they were a premium brand, high quality, selling very expensive to the very best, but they realized that revenue was falling, sales was declining rapidly, sales had taken a nosedive. So they said, okay, you know what? Let's do hybrid. So they will now do premium and some relatively more affordable boards so that those who are very price sensitive, a local artisan, a local developer who wants cheaper materials to finish their interior, to do their construction, can also buy from them. In terms of their strategic initiatives, generally, we've been told that they use superior European technology, their panel saws, their optimizers, to deliver precision, reduce material waste, and justify a quality-focused market position. Right. So, of course, we can see the focus on using the best of the best. In terms of sustainability, we've been told they are actively pursuing sustainability by sourcing certified products. They are investing in energy efficient machines to reduce their footprint when it comes to what consumption of resources, right? They are planning a shift from fuel petrol to electric vehicles by the end of 25. So they want to go EV. And of course, this is also to reduce their carbon footprint. And they are digitizing all customer documentation since January 2025 to reduce paper waste. Of course, again, printing less and using digitized solutions to reduce what? The use of paper and its adverse impact on the environment. In terms of international expansion, we've been told that they are planning to do a high risk, high reward establishment of a factory in Lagos, Nigeria by the end of 28, right? Give or take. That is their plan, right? And they aim to capitalize on a large market, but they face immense operational and cultural challenges. Nigeria is a very unique market for anybody who knows Nigeria, right? Very, very unique market. So late 28, early 29, they are planning to do Nigeria. But the question is, are they ready for Nigeria? Then data-driven management. We are told that Mr. Turkson uses a robust Microsoft Excel dashboard, which allows for real-time monitoring of daily, weekly, monthly, and annual sales, inventory, and customer data, enabling agile and informed decision-making. But my question is Microsoft Excel the best he could use at this time? With all the data analysis tools out there, we've got very solid, very robust tools today. Right? We're looking at Power BI, looking at what the use of SQL-backed dashboards, right? You could use Metabase. So is Microsoft Excel really the best at this stage in the company's trajectory, right? But then again, that's what we have to. At least he has something he uses to track. Again, you can see the founder, Mr. Turkson, is tracking or monitoring daily, weekly, monthly, annual sales, inventory, customer data, right? Himself. Domestic expansion, like I said, they are planning to establish a smaller factory in Kumasi by 26, which follows existing customer demand into a new region, right? Then product development. They have a future plan to add hard glass also for construction, right, to their portfolio, which would enhance their true one-stop shop model and increase the value proposition for customers. So they want to be known as that company. When you go there, most of your interior finishing for property, for construction, you get. So their plan is to add hard glass. But as I'll talk about shortly, there was a failed product. I'll discuss that with you shortly. So how are they planning to launch this to ensure it's successful, right? For leadership, we'll start with Mr. Turkson Blessing. He's the managing director. He's a 70% shareholder and he's the chairman. He's an experienced IT professional, currently 44 years of age. He has over 15 years of experience in the banking sector, right? He's the primary strategic driver. His leadership style is he's approachable, he's flexible, and is intensely customer-centric. He develops personal relationships with clients and the core staff. So he's the founder who is in the game. He's got a skin in the game, right? In terms of impact, his style fosters deep loyalty among a core group of skilled workers, but his flawed view that corporate or formal corporate governance is an unnecessary burden for a private company is a major strategic risk. To him, we're a private company. What is our business with corporate governance? Like, what do we have to do with all of these board committees and corporate governance structures and all of that? Like, to him, it is not important for a company like this. But we all know that this is not accurate, right? Mrs. Turkson is a chief operating officer, holds 30% of the shares. So you can see 70% held by Mr. Blessing or Mr. Turkson Blessing. Then the COO owns 30%, right? Now, this is Mrs. Turkson. Mrs. Turkson. So it's family, right? So she's a former banker, 2 years younger than her husband, right? She has over 10 years of experience in operations, responsible for all non-operational departments. Her leadership style is quite the opposite. She is more structured. She is more rules-driven. She emphasizes strict compliance with policies and hierarchies. This creates a stark contrast to her husband. So whilst the husband is more approachable, flexible, people can approach you, talk to him, he built a good relationship with everybody. His wife is the more serious, always let's do business kind of character, right? Very strict. Now, her management style is perceived as stringent and uncompromising by the factory workers. And we've been told it's actually the primary cause of the company's high labor tenure. People are leaving because of her. And this is another strategic risk. Again, two founders, right? Husband and wife. The man is the more approachable, flexible, friendly character. The wife is the more serious military style leadership person. And people are leaving, like I mentioned earlier, very high turnover. And we've been told she's a primary cause. So this is something that has to be fixed. But you see, the challenge is it's a family-run business. How do you fix this? Right? Okay. There are some additional key figures. We've got Mr. Oti Nelson, who is a non-executive director. He's a professionally qualified chartered accountant. He's a lawyer. He holds degrees from the University of Ghana Business School, UGBS. His independence and ability to provide objective oversight are fundamentally compromised because he's also a family friend. So just when we thought there was light at the end of the tunnel with a non-executive director, this guy happens to be a family friend. So how do you do effective governance if this is family and friends, like I said when we started? Now, we've also got other family members in management. So the head of HR and administration, the head of stores are also family members. So the head of HR and admin is the sister of Mr. Turkson. The head of stores is the brother of Mrs. Turkson. So they've brought siblings to also head HR and admin and what? Stores. Now, if the head of HR, okay, head of HR happens to be the sister of Mr. Turkson, head of stores is the brother of Mrs. Turkson. If there's something going on that is not really the best for the company, how will these people be able to address them? So the placement of family members in key management and board roles, according to me, it reinforces the concentration of family control and undermines the development of a professional, merit-based management structure, right? If it is filled with family members, how would those in the company believe that, oh, if I work hard, I'll be able to rise to the top? If you look at the top where you work and everybody there's a family member, I'm sure you advise yourself, right? So that is what we have in this company. Now, for governance to delve deeper, this is, in my opinion, the company's most significant internal weakness, which will probably come biting them in the future, right? So in my opinion, let's look at the governance structure. For the board composition is heavily dominated by family, with 4 out of 5 members being the founders or their relatives. So in the 5-member board, based on information they're pre-seen, 4 out of 5 will either be founder or family member or founder, right? And this prevents diversity of thought and experience. Don't forget that the only one person ends up being what a family friend. So there's also lack of independence. The presence of only one non-executive director who happens to be a family friend means there is no mechanism for objective scrutiny or the independent challenge of the executive decision. If the only non-exec, the NED, right, who is on the board is your family friend, how then can he be an effective non-executive director? In terms of concentration of power, Mr. Turkson holds the conflicting roles of MD, and he's the board chairman, and he has 70% majority shares. This company is really like a sole proprietorship or a partnership, if we are being honest, right? The MD, who is a CEO, by the way, is the chairman of the board, and he holds 70% of the shares, right? Yeah. You could just as well say he runs the whole show. So this violates a core principle of good governance and concentrates absolute unchecked power in one individual. And don't forget, if the 30% would have been held by maybe another investor, fine, but it's held by his wife, his own domestic wife, right? Ineffective operations. The board is not functioning effectively, right? From the pre-scene, it fails to meet the minimum of 4 meetings per year as required by the company's charter. The highest number we've been told is they meet 3 times, and they have never ever conducted a performance review of their members. So you can't even tell who is performing well and who is not, right? And they don't even meet as much as they said they'll be meeting, right? Again, it's not the best of governance structures, right, for a company at all. There's also the flawed philosophy. Mr. Turkson has this misguided belief that formal governance is an unnecessary and costly burden for a private company. Right. So this ignores the risk of unmanaged growth. This founder believes that we are a small company. What is all of this governance and board and secretary? Right. He doesn't believe in that. So it's very, very bad for this company. It's going to hit them where it will hurt the most. Right. Let's touch on some financial information next. So in terms of capital structure, based on the pre-scene, we've been told they are financed by a mix of substantial equity, of course, from the founders, and they have considerable debt. So for their capital assets, we are told is financed predominantly by some debt, right? This indicates that the company is geared, and there's what? Financial risk, of course. So as to the extent of the gearing, we might find out in the unseen, which may be shared on exam day when you go to the exam hall, right? But at least we know that their capital structure is a mixture of debt and equity. They rely on external financing from debt. Okay, that is it. Now, regarding debt, the cost of debt is exceptionally high. We've been told that between May 22 and June 25, the cost of borrowing was averagely 34% per annum. Now, if your company are paying 34% as interest on loans, right? This erodes a lot of your margins. Okay, so this creates significant financial risk, puts severe pressure on their profit margins, and sets an extremely high hurdle rate for new investments. Because really, if you need to pay 34% on all borrowings, that's a lot of what money going into interest. Does the company have an alternative financing source, right? Apart from, of course, debt and equity, but what other options can they explore, even within debt and equity, right? In terms of their liquidity management, we've been told that they successfully strengthened their cash flow by pivoting from a detrimental credit policy, which led to a lot of bad debt and impairment of what receivables. Now they are doing cash and carry system. Only their top 10 customers will get credit. This demonstrates that they have learned from their past financial mistakes. But again, we are in a country like Ghana, right? If you do strict cash and carry, right, you may lose some customers, of course, right? So maybe they should be a little bit flexible here. But again, they learned from their past mistakes. They realized that they were writing off a lot of debt, impairing a lot of receivables. So they said, okay, only my top 10 trusted customers will get credit, right? We've been told that the formal finance and accounting function has been outsourced. Okay, so there's someone who handles this for them. Mr. Turkson still maintains strong internal financial control Like I said, he has a real-time Excel dashboard. He uses this to monitor sales, costs, and customer profitability by himself, right? Then operational gearing, like I said, the company is highly geared operationally because they have invested heavily in expensive machinery, which makes their profitability very sensitive to fluctuations in sales volume. That is operational gearing. Regarding past performance, we've been told they incurred substantial financial losses from a failed diversification into aluminum profiles. So that's why I said they want to go into glass, right? Now you've tried to diversify into aluminum profiles and you failed drastically. You failed in the biggest of proportions. So this highlights significant financial risk associated with poorly executed strategic initiatives. This is a company that is seeking to even go to a new market. Were you able to successfully diversify into a new product? It should be relatively easier to do product diversification than market diversification, right? But again, let's see, they plan to go to Nigeria. They plan to go big or, go hard or go home, right? So they're rather going to what? Keep trying to succeed, right? So that is it for this one. Let's look at PESTEL. Now, PESTEL is a very popular model. Let's analyze the company using PESTEL analysis. So political, the Africa Continental Free Trade Area is a major opportunity which reduces trade barriers and underpins the strategic rationale for the planned Nigeria expansion. Now, remember I said when we started that they are importing heavily from the Asia Pacific region. Once Africa Continental Free Trade Area opens up the doors, they'll be able to what? Import from other relatively more competitive and more quality African markets. And this will cut down the import costs, which comes from importing from China, right? So here for political, the first one I'll talk about, or the key thing, which would be an opportunity for them if it works out, is the Africa Continental Free Trade Area. In terms of economic, I would say this is a primary external threat for the company. Why? We've got persistent currency instability. This erodes their margins on imported goods, because if you are importing as a supplier, you have to deal with the dynamics of the dollar and the cedi, right? So if you are having a depreciating currency, you need more cedi to get the same dollar. And that would hamper on the company's ability to grow sustainably. Then I mentioned just in the previous slide, the elevated financing cost, 34% per annum. This is another threat, right? Economic wise, it means the interest rate regime can be quite high, right? Of course, we know interest rates are dependent on so many variables, such as the Bank of Ghana monetary policy rate or the lending rate, right? So, of course, if the interest rate regime changes, this can also change trajectory or direction. So this makes investment prohibitively expensive. We also told that there's high electricity tariffs, which also increase their operating costs. High electricity tariffs, which would increase their operating costs. Then social, Ghana's got a large and growing housing deficit of 1.7 million units. The housing deficit will be their advantage. Again, because people have the demand for housing, okay? We are going to see people actually naturally look for products to finish their interior. Okay. So there is the demand, but don't forget there is the competition. So as for the market base, it is there, but they are facing intense competition. Then technological. There's a lack of qualified local engineers. This creates a costly and risky dependency on the single specialists they fly in from Italy to maintain their machines. This costs a lot of money, right? From a tech standpoint, they don't have the person who can work on the machines. Also, we are told that EWL's own online system is failing and is vulnerable to fraud, which hinders its digital presence. So regarding technology, they are struggling seriously, right? They need specialists who can work on the machine, and even their online systems are not strong. They are vulnerable to fraud, and this can work against their growth. Environmental, we've got global sustainability trends like LEED and EUDR, which favor importers of certified products like EWL, while illegal logging or galamsey devastates the domestic timber supply, creating an opportunity for sustainable importers. So whilst that could have been an opportunity, the legal side of things shows a different picture. There's a weak enforcement of forestry and mining laws in Ghana. That's the truth, right? So this facilitates the illegal logging, which threatens the local industry, right? So because there's illegal logging, people are doing or cutting down trees very fast. We don't get the trees to process into these finished products. So there is a gap in the local market, and which would have to be filled by imports from outside Ghana, right? So these are the issues, right? So although there is opportunity, we've got the laws are not being enforced. Okay, the laws are not being enforced. Regarding the SWOT analysis, let's start with their strengths. We've been told that they've got a state-of-the-art European machinery, which enables precision. Again, this is something that differentiates them from their customers internally. I mean, from their competitors internally, right? Then we've got the customer centricity and personal relationships driven by the MD. Now, we are told the MD is a very friendly, very customer-focused, very approachable person. It's a strength, right? People look up to him. People can work with him easily. Then there are also strong supplier relationships where they get 60 to 120-day credit terms. This gives them a longer payable days, which ends up feeding into their working capital cycle, right? So if you're looking at your cash conversion cycle, then you are considering your inventory days plus your receivable days minus your payable days, right? So we are told they've got 60 to 120 days, right? That's a lot of time for a company, right, to pay its supply. So it's a strength. They can manage liquidity well. Then they said there is a robust internal data analytics via the MD's dashboard. Although this gives him an insight into operations, he gets to see numbers on the go. My question is this the most up to date? Is this the most competent he can use? Then they want to achieve being a diversified one-stop shop. That is the model they are aiming to have. This will be a strength because, again, it's easier for customers to shop from one business that can meet all their demands or all their needs than to go to different persons for this one I want to buy from this company, that one from that company, right? Regarding weaknesses, the second internal side of things, like I said, there's a critically weak corporate governance structure with a family-dominated board. Big weakness. We're also told there's poor HR management where there is very high turnover. People are quitting the company. They pay their people very low. People work for very long hours, and there's no formal contract for the new recruits. Big weakness, big HR weakness. People are leaving. You don't pay them well. They work for so long, and you don't even give them proper formal contracts, right? So HR is clearly in shambles, and we can see it's led by a family member, right? So these are issues that need to be resolved. There's also a conflicting leadership style, which creates a dysfunctional culture. On the other hand, the founder, is very friendly, approachable, customer oriented. Then we have the wife, who is the military style. Everybody must follow the rules, and she's causing people to leave. So there's a conflict inside the company. We also are told of a failing online system, which alienates customers. So their digital infrastructure, digital footprint, their digital interfacing with customers is not the best, and they need to work on it ASAP because we are in a globally digitized economy, right? Then high degree of key person dependency on the founders and a foreign engineer is a big risk. We have key person risk here. When we say key person risk, it means the company depends on particular persons for something with no alternatives. So the founders, husband and wife, we depend on them too much. They're even the shareholders on top, right? Then we have a foreign engineer who has to be flown in. Which is serious, right? What if there's COVID-19 again and we close borders? Or for whatever reason, Ghana closes its borders. What happens? You see, so this is a big weakness for the company. Then opportunities domestically, they want to go into Kumasi, which is, if done right, if executed well, it's a very big opportunity. Then the Nigerian expansion. I'm calling it an opportunity because if it works out well, the Nigerian market is way, way, way bigger than the Ghanaian market. If it works out well, great opportunity, right? Then the strong underlying market demand from Ghana's housing deficit. For Ghana, we need to build houses to close the gap. So the demand is there. And then there's the further development of a product into complementary areas like hard glass, which I mentioned earlier. So again, if this is done well, it truly enforces their position, it buttresses their position as the one-stop shop for all construction needs, right? So if hard glass works out, great opportunity for them. Regarding threats, there is the intense and escalating competition from the cheaper imports. People are bringing in cheaper things from outside Ghana. Cheaper things are coming from outside Ghana. And then this is going to be like a big issue, right? There's severe macroeconomic volatility where we have currency depreciation, high interest rates, right? This is hitting the company financially. Cheaper imports, like I said, if customers realize they can get something comparable at a cheaper price, they'll buy from them and not you, right? Then, like I said, there's a brand damage from artisans who are misrepresenting inferior products as being products of this company. There's also the constant risk of poaching of skilled core staff by competitors. Again, we are told that there's high turnover, low pay, long hours of work, and no formal contract. So it even makes it easier for competitors to come and poach your employees. When we say poaching, it means they encroach. They come and then they offer them better offers, better salaries, and they leave you to your competitors, right? Now, this is an industry that needs highly skilled persons, especially in operations, in production, right? So if your skilled people are always leaving, then this company is a bomb waiting to detonate very soon, right? So this is what I'll talk about, preliminary SWOT analysis for this company. Let's apply another popular model, Porter's 5 forces. This model looks at the competitive external environment. So how does the threat of new entrants look like? To me, this is medium to high, right? Because we've been told that there's high capital requirements, roughly $10 million to establish. And this is a significant barrier, right, for importers. You need capital. The threat remains high, however, from new foreign distributors who can enter the market with skill and aggressive pricing. So although those who want to do direct import would need the kind of capital EWL has, it is so easy in Ghana for the foreigners to come in, right? They have their foreign currency. They can come in, enter the market, and undercut you regarding pricing. So the threat of new entrants is medium to high. It's not low at all. This market is open. It's not a market which is regulated where you need a certain license, you understand, right? It's quite open. Bargaining power of suppliers is high, in my opinion. EWL is highly dependent on foreign suppliers for both their products and their machines, right? Their power is amplified by the cedi's depreciation, which impacts EWL's cost of goods sold. So as for this company, they are dependent on supplies. Even the person to come and fix your machines, you import them, in quotes, you bring them from outside, right? So there's a very high bargaining power of suppliers. Whatever they charge, you'd pay. You don't have that high or that much of bargaining power over suppliers. How about customers? Bargaining power of your buyers is also high. Why? Because large construction firms will negotiate bulk discounts. And those who are price-sensitive artisans, they'll go to cheaper people. They are a key channel to the market. They can, and they do easily switch to cheaper alternatives, putting constant downward pressure on prices. If you see your artisans, the building construction guys, always going to buy from cheaper people, it will force you to also cut your price. So again, this company's hands are tied, right? Bargaining power of buyers is high. Supply is high, right? So they are in a very dicey situation. In terms of the threat of substitute products, I think that is also high. There's a wide range of substitutes. Alternative materials like metal, plastics, composites, and the ever-present option of cheaper, lower quality wood products can always be used. Not every Ghanaian will want to use these high quality premium materials internally for their building. Not everybody. So there's a very high threat of substitutes. People can look for alternative products to also do the same thing these products will do. So they are not in a unique market where it is difficult to find an option to replace. How is the rivalry among existing competitors looking like? This is the last element of Porter's 5 forces. This is also very high. The case describes competition as quite intense. This is characterized by aggressive price wars, fueled by an influx of cheaper foreign goods and the active poaching of skilled staff between rival firms, right? So the rivalry is quite intense. This will be our analysis of Porter's 5 forces. We can now look at stakeholder mapping, which is one other popular model, which is the Mendelow's matrix. Now, this looks at your stakeholders, mapping them based on their power and their interest. Let's start with the first quadrant, which is your key players. These are the ones who have high power and high interest in the organization, right? So we start with Mr. and Mrs. Turkson. They have total strategic and operational control as founders, managers, and majority shareholders. Right? They are the key players in this precinct predominantly, right? They've got high power and they've got high interest. The interest is what makes this one what makes them fall here, because they have high power and they care, they have high interest, right? Then we have those who should be kept satisfied. So who should you keep satisfied? Those with high power but low interest, right? So your lenders, the banks, for example, they give you essential but expensive capital. They don't have too much of an interest in your business, but they have high power. If they pull the plug, if they take their financing from you, how would you run your business? Your key suppliers, they provide the vital 60 to 120-day credit terms, as well as a small group of loyal, skilled core machine operators who are critical to service quality. These guys must be kept satisfied. They've got high power. Although their direct interest in the business might be low, they've got very high power and they must be kept satisfied. Then we have those who must be kept informed. These guys have low power, but high interest. So the general factory workers who experience high turnover, they don't have the power, but they are interested. Why? They earn their living from the salary you pay them, with the wages you pay them. Then the artisans who are a key channel, because these guys are the ones who buy from you and use it for construction, but also a brand risk. We are told that some people are doing brand dilution or causing brand dilution by putting inferior products out there as EWL products. And the top 10 customers who we've been told have been given special credit terms to pay on a credit basis, they have low power but high interest. That is it, right, for this one here. They are very interested because these are people who buy from you and then they are interested in what the credit terms you've given them to keep them informed from time to time. Somebody might say, oh, I could have put them under high power. Well, fair, but they are a customer. They can just choose to buy elsewhere, right? So if you see from that angle too, you can say they are more high interest. Then those you must use minimal effort for, low power, low interest. There's a large base of general cash and carry customers and the local communities that receive occasional CSR support, right? This one, you put in your best, do what you can for them, right, from time to time. So this will be our stakeholder mapping using Mendelow's matrix. Let's look at BCG Matrix, the Boston Consulting Group, BCG Matrix. Now, this categorizes your product portfolio into a quadrant, like 4 different boxes of a quadrant, based on what? The growth of the market and your share in the market. Market growth, market share. Now, we'll start with the stars. High growth, high share. I will put engineered wood products here. So this is EWL's core business, holding a strong share in a high growth market driven by the national housing deficit. So their star, which brings them the most, will be the engineered wood products. Then we've got the cash cows. These products have low growth, but you have high market share predominantly, right? This will be their services, predominantly the cutting and edging. So this is a mature but essential offering where EWL's technology gives it a strong position, generating funds that could support other parts of their business. Right, so this will be low growth but high share. Then we've got the question marks. These would have what? High growth market but low market share. Okay, we can put here the stones and quartz and appliances. These are in high demand, or they're in high growth segments of the one-stop shop market. But as they are recent additions, they likely have a lower market share, which requires investment to grow. Again, based on the limited information we have in the pre-scene, this is where I would place it. Then we have dogs. Dogs are products or portfolio, part of a portfolio that have low growth and low market share, right? So the discontinued aluminum profiles line, we are told that this was a low share product in a low growth market, which was correctly divested. They quit that business, right? But we are told it was at a substantial financial loss, right? So these are the quadrants of the BCG matrix: your stars, your cash cows, your question marks, and then your dogs, right? We can also look at Ansoff's growth matrix, another very popular model. This one looks at whether you are developing new products or developing new markets, right? Just doing a plain diversification or staying where you are. That's all, right? So we start with market penetration. So the introduction of relatively more affordable boards to compete more aggressively and take market share from cheaper rivals in the Ghanaian market, existing market, is market penetration. This is where you offer your existing products to an existing market. We are told that they are trying to put in relatively more affordable boards into the market, again, to try to capture some part of the market that they have lost. Then we look at market development. This is where you take your existing products to a new market. So the plan to sell existing product portfolio in new geographical regions, specifically going to Kumasi and going to Nigeria, will fall under market development. So you're going to take their current product portfolio and sell to Kumasi, sell to Nigeria. This will fall under market development strategy. Then we have product development. This is where you sell new products to your existing market. So this is the introduction of new products like stones, appliances, and accessories to its existing customer base in Ghana, with a future plan to add hard glass. If they sell these new products to the existing market in Ghana, that is product development. Then diversification is where you plan to sell a completely new product, mostly to a completely new market. So we can put here their failed attempt with aluminum profiles, which was a related diversification, which means similar products, right? But it did not succeed in the market. So they had one failed documented diversification strategy. Okay, so this is Ansoff's growth vector matrix, as some people call it. Let's look at Porter's value chain. It breaks activities into primary activities and support activities. So primary activities will be where value is directly created. So we look at inbound logistics. Mr. Turkson, we've been told he's involved in direct management of procurement from Turkey and China. He has established strong supplier relationships and has secured favorable 60 to 120-day credit terms. This includes warehouse of imported goods in 3 separate facilities. So this is the inbound logistics for the business, very key to the value chain. Okay, operations is next. Regarding operations, we are told that this is a key value creating activity, of course. It involves the use of state-of-the-art cutting, which is 4 machines that they have, and edging, 3 machines, to process boards with high precision, supported by optimizers that minimize waste. Then outbound logistics. This is the transport of finished goods from warehouses to the factory and the use of a fleet of 5 delivery trucks to transport completed jobs to customer sites for installation. So we've seen inbound logistics, operations, and outbound logistics. The 2 other parts of the primary activities will be marketing and sales. We are told that EWL relies heavily on word of mouth and customer referrals driven by product quality. It has a very weak formal marketing function. There's no sales personnel, and they are even failing with their online sales channel. Very, very devastating, very, very tragic turn of events, right? This company needs to turn things around. Very important, right? Okay. And then service. This is a major differentiator, right? It includes pre-sales activities like job specification and optimization, and post-sales professional installation services, which creates a hassle-free customer experience, right? So when it comes to service, we've been told that they do their best to offer high quality services, right? They have pre-sales activities where they look at your job specification, they optimize for the customer. And even after they are done, they do post-sales professional installation. So at least from the service side, this company is quite competitive. Okay. Then support activities. Okay. Which enable the primary activities. Okay. So we have firm infrastructure. The company's management structure, including the hands-on approach of the founders and the outsourced finance function. However, the weak corporate governance detracts from this. So they have a hands-on approach for the founders. They have outsourced the finance function, but their weak governance detracts from this. Their weak governance detracts from this. Then HR management. This is a major weakness. While Mr. Turkson retains a core team through personal relationships, the broader HR function is poor, leading to high turnover due to low pay, like I mentioned earlier. Long hours, sometimes 13 a day, and Mrs. Turkson's register. So HR is in shambles. Then tech development, we are told that they have invested in cutting-edge European machinery and optimizer software. This is a core strength. Conversely, the customer-facing online system is a failure, and the reliance on an MS Excel dashboard, while effective, may not be scalable, like I said. And finally, procurement. Mr. Turkson has an expertise and network in sourcing high-quality machinery from Europe and products from Turkey and China. So these are important as support activities. So this is what we call Porter's value chain. It breaks a business's entire value chain into primary activities where value is directly created and support activities which will enable the primary activities, right? Okay, let's now analyze the company's resources and their competencies. Now, for resources and competencies, you could break your resources into your threshold resources and your unique resources. Threshold resource and unique resource. Now, threshold resources are the things that are necessary to compete. Without them, you can't even survive in the industry. We are told the company has got warehousing facilities. So they've got 3 warehouses. This is a basic requirement. Once you're in this industry, you need a warehouse. So at least they've got that resource. They've got a delivery fleet. So the fleet of 5 trucks is necessary to offer installation and delivery services as expected by customers, and basic cutting machinery. The manual panel saw represents the minimum entry requirement for processing board. So these are not special. If you've got the threshold resources, you are barely competing. Everybody has this, or everybody must have this, more like that, right? Let's come to their unique resources. These are the things that you have that may be difficult for competitors to imitate. So you've got a state-of-the-art European machinery. So the specific semi-automatic, and fully automatic high-precision panel saws and the edge banders are expensive and difficult for smaller competitors to acquire. You see, it requires capital to actually acquire some of these machines. This company has got it, and it may be difficult for the smaller players in the market to be able to compete. They also have strong supplier relationships. The trust built by Mr. Turkson allows for 60 to 120-day credit terms. This is difficult for people to imitate. For you to get these foreign suppliers to give you this long period of credits, it means they trust you. It is not something to be taken for granted. We are told Mr. Turkson has got IT and management acumen, right? At least he has a dashboard. He has deep industry knowledge, and this can be a unique resource. Again, of course, people can hire other people in their competing companies, but for now, we can say these are not easy to imitate by competitors. So these are your resources broken into threshold and unique. Then your competencies. We have the threshold competencies. These are the things necessary to operate in your business. And the core competence is what you do best that gives you a competitive advantage. Okay, what are the threshold competencies? Inventory management is mentioned. So the ability of the company to manage stock levels across 3 warehouses and the factory is a fundamental competence. There is basic customer service. The ability to take orders, record measurements, process payments is a standard practice. So this is threshold. Everybody needs to have this to be able to operate. Let's come to the core competencies. These are the things that you'll be able to do so well, and it creates a unique competitive advantage for you. The first is precision finishing. We are told in the pre-scene that the company has the ability to leverage, right, its unique machinery and skilled core staff to deliver exceptionally precise cutting and flawless edging. This is the foundation of their quality reputation and service offering. You would love the finishing of their products. Very high quality. We're also told there is agile data-driven procurement. So the competence is driven by Mr. Turkson's dashboard. He's able to tell when they need to have the reorder levels and all of that. He manages inventory. This helps him to analyze real-time data and make smart, timely procurement decisions, optimizing stock of colors and board types based on the demand. So he has a chart, a dashboard. It shows him that, okay, this product, people are buying more. This one, they are buying less. Let's stock more of this. Let's stock less of that. Or this one, we have 40 more left in the warehouse. Let's bring more in, right? He's able to do this. Of course, this is something people can copy if they want to, but at least for now, it's something he does that makes them stand out regarding procurement. They are integrated one-stop shop solution delivery, which is their ability to combine a wide range of products, such as wood, stone, fittings, with value-added services like optimization and installation, provide a complete convenient solution for the end customer. So these are their core competencies, right? So this would look at some of the models. Then I would talk about 10 strategic questions to reflect on. As a candidate writing this exam, what are some things that you should keep in mind? Okay, as you are doing your own analysis, what are the areas that you should have in mind, right? The first one is governance and expansion, okay? How can the current board, which lacks independence and formal review processes, credibly oversee the immense financial and operational risk of the Nigerian expansion? This is the first question you should think about. Governance and expansion. The company in its current form, are they ready for Nigeria? And when I say this, if you know Nigeria very well, it is a completely different beast of a market. Different. Are they ready with this governance structure to go to Nigeria? The next is the risk of ambition. Is the Nigerian expansion, what I'm saying you should think about, is it a feasible strategic leap? Is it a case of running before you walk? Given that the company has not yet solved its fundamental governance, HR, and IT system issues. My question is, you've not even sorted internal governance issues in Ghana. HR in Ghana, people are leaving, you're not paying them well, no formal contract, high turnover. Your IT systems are not working for the sales side of the customer-facing part of your business. How then are you going to Nigeria? So is it over-ambition? Think about this. Are they expanding for the sake of, I also want to expand? Are they really ready? The next thing to think about is human capital. So in your syllabus, there's functional strategy. So HR strategy will be a key thing to think about here. How will the company solve their high factory staff turnover? People are quitting. You need skilled labor. This creates operational risks and directly contradicts the corporate vision of human capital development. What specific changes to pay, hours, and management style are needed? What will we do to Mrs. Turkson? Right? What do we do to her? Okay, so HR is a big issue. And how does the company intend to address this? The next thing for you to think about is their financial strategy. Okay. How will the Kumasi and Nigeria factories be funded in an environment where we have 34% interest rates, that is Ghana, and high currency risks? Don't forget the Nigerian naira is also having its own issues with currency depreciation. So is debt financing viable? Or must the company consider alternative financing like getting equity partners? The market you are going in Nigeria faces or has a similar macroeconomic landscape compared to Ghana. Similar, right? So how do you intend to manage Nigeria if you've not mastered Ghana fully? Then leadership conflicts are another big issue. How will the company reconcile the conflicting leadership styles of Mr. Turkson, which is flexibility, and Mrs. Turkson, who is more rigid? Okay? These are a direct and acknowledged what? Cause. So Mrs. Turkson, we are told, direct and acknowledged cause of staff turnover and cultural dysfunction. So how is that going to be managed? Then brand and channel management. What is the company's strategy to regain control of the brand from artisans who are actively damaging their premium reputation by substituting cheaper products? How can EWL build a more direct relationship with the end consumer? So because people don't buy from you directly per se and artisans buy and go and use, artisans are now saying, oh, the cheap products they are using are from EWL. And it's creating a poor impression in the minds of customers. How do you plan to manage this? Because if it goes on for a while, trust me, the brand is going to suffer irreparable damage in Ghana. Then digital transformation. What is the plan to fix the failing online system, which is currently a liability? How can a modern digital platform be used proactively to solve the artisan problem? For example, maybe they should consider a direct-to-consumer app, mobile app, or an installer certification program so that only certified installers can install their product. So if the person installing is not from EWL, then sorry, I don't know them. You issue a disclaimer to that effect. Then succession planning. The hope that the 5 children of the family, right, will take over is not a strategy. You can't hope. Hope is not a strategy. What is the formal professional succession plan for the 2 founders who are central to all strategic and operational activities? What happens if they die? Who's going to take over? Right. Then strategic focus. Is the one-stop shop model stretching management and capital too thin? Maybe they should focus on some selected things. How will the company avoid repeating the failure of the aluminum profile diversification as it adds more product lines like the glass, the hard glass? You try to diversify into aluminum profile, it failed in epic proportions. What have you learned from that that will make your successful diversification effort successful, right? How would you plan to go to Nigeria and Kumasi even to what? Also have a successful operation there. Then operational resiliency. What is the strategy to mitigate the major operational risk of relying on a single engineer from Italy for all your critical machine maintenance? What steps can be taken to build local capacity? Right. So these are the top 10 strategic questions you should reflect on as a candidate, right? So I'll end the session with, as like I said when we start, an invitation to join our strategic case study 2-day pre-scene deep dive session. Again, the purpose of this is what we've done for this, for some selected models, we'll do it for every single model in the syllabus, all of them. Quartz 5 forces, Porter's diamond, Ghanaian's growth model, BCG Matrix, Shell directional policy matrix, you name it, all of them, right? Every single model would apply it to the pre-scene over a period of 2 days. We'll deep dive further, we'll discuss strategy, talk about best practices for strategy, right? And governance in general, right? And then we'll touch on finance based on the information that we have in the pre-scene. To register, visit our website, mslbusinessschool.com/intervention. You can also reach our team on WhatsApp, 0535797181, and they will assist you. So I'll end here. I wish you the best in your preparation for the ICAG November 2025 Strategic Case Study exam. Have a lovely day and all the best in your exam prep. Bye.